Morning, everyone. Welcome to this morning's edition of the MPC Markets Morning Call, 3rd of November 2025. AWS, after their earnings, which we spoke about on Friday, which came out that Thursday evening in the US, our Friday morning, continue to drive the AI thematic. But there are a few indicators out there that they're showing that the breadth of the rally is sort of dangerously sort of narrowing at the moment, which you can sort of see here with the Russell was down 1.36 for the week, but the rest of the NASDAQ, the S&P up 2% for the NASDAQ and 0.7 for the S&P, but all very much driven by that high concentration of the AI stocks. One of the major themes, it did seem to be significant concerns, or a significant amount of concerns in terms of broader sentiment around how much money is being spent on this AI expansion, etc., and the capex that's involved and how much revenue's got to come to cover it, essentially. But overall, it looks like a decent result, I suppose, for the US market. But as you can see here, the Aussie was down slightly, but down 1.5 for the week. The Hang Seng was down 1.5 and 1% for the week. China was down about 1.5 for the week and for the day and things like that. So, and the Euro stocks was down for the week only very slightly, but basically you're starting to see those roll over into selling territory. Nikkei's doing its own thing at the moment. New leadership, fairly large shift in general fiscal policy and potentially monetary policy for the Japanese. So, they had Trump over there for a portion of the week as well. So it was very much, I think it's just sort of dancing to the tune of its own beat. But as you can see, that we've started to see these indicators swing back around to a little bit weaker. And as you can see here, basically we had, Amazon up 9, Tesla up 3, CVX did okay, but look, Meta was down, Microsoft down, Broadcom down, Apple was up initially and sort of started to drift off. Netflix bounced, but has had a pretty poor week overall. So, but I mean, Amazon up 9.58, and that shining light of the data centers, obviously, keeping things relatively buoyant. But it's a fairly mixed market map overall for the S&P 500, and we had an indicator which, for some people, and I had to even go and do a little bit of research on this myself. So this obviously super ominous title, but the Hindenburg Omen. So basically the Hindenburg Omen is when significant amount of stocks simultaneously hit 52-week highs and 52-week lows, and they exceed set percentage threshold. So it's just, the reason I'm going through this is because it's sort of interesting, and to talk about what the breadth of a rally and this concentration in the in the Mag 7 stocks, which are basically, that thematic is kind of almost exclusive to the rest of the market. And there's a lot of it. There's a lot of talk about it on social media. So I just wanted to explain it to everyone, because it's not exactly easy to explain. Now, the market index must be in an uptrend, meaning it's above its level from 50, from 50 trading days previous. And the market breadth indicator, such as the McClelland oscillator, must show negative momentum. What I've done here for you is the candlestick chart is the S&P 500 in the last 2 years, up 63% overall at last night's close. But what we're talking about with the breadth of the market here, the blue line, that's the S&P if you equally weighted every single stock in the S&P 500. So if every single stock was worth exactly the same amount, and as you can see, it's only up about 38%. So a fair difference in performance. So that gap there really is most of the heavy lifting being done by all of the AI stocks, really. So that's sort of a good way to show you what the breadth of a rally means. And at the moment, it's quite narrow, and that obviously is the largest gap we've seen in quite some time. And here's some positives out of this. essentially, if you're gonna have a look at this, 30 to 40% of the time, there is no major correction when these groups of stats do trigger. As we can see here, these are the major ones, and then obviously 20 to 25% of the time only it predicts a major crash. So it's not as ominous as it sounds, but all of the stats that have been put out there, I've seen on social media in the last sort of 48 to 36 hours, been extraordinarily, picky with their numbers, basically. So, but generally, it's a pretty decent buying opportunity. One thing you'll notice, so this is back in 01 or 2001. So it was 68 days or thereabouts to the absolute lows, pre-dot-com burst. There was a lag on the move from it first being triggered to when it actually started to fall. These obviously are far more significant over time. But as we've done in previous morning podcasts, since this period here in 2010, as you can see, markets are much faster to fall and to also then turn around and bounce back. So these are a few of the more significant ones. And really what it shows is once it triggers, it's not a bad period to go to cash. And then from that point, it's then probably not a bad point to be buying the dip, essentially, because if you have a look at it overall, these elongated, this is the GFC, so this goes for a long period of time. That's the dot-com bubble. We don't really have any, we've got private credit issues, but we don't have any systemic bank issues. The dot-com bubble, as expressed by Fed Chair Powell, like these guys have got revenue, whereas these guys didn't have revenue. So it's a very different situation, I would imagine. So basically, I guess what I'm saying in the end is don't be too fearful, but probably not the worst place in the world to be going back to some cash and preparing for a decent buying opportunity. But as I say, 30 to 40% of the time, there's no major correction and it generally went sideways. So that's probably the most likely situation. And then that 20 to 25% is, where it might predict a major crash. But don't believe the hype, because the people publishing this stuff on social media are basically trying to tell you that this thing is due for a dot-com bubble style correction or a GFC. But they are being extraordinarily picky with their data, because they don't mention that 20 to 25% of the time is the only times it actually predicts this. The other 75% of the time it doesn't. So gold and silver drifted off a little bit on Friday night as well. We had US dollar up slightly, which probably didn't really help. No, I wouldn't say any particular moves. Uranium gave back a little bit, but it was up about 13% on a 5-day period. Copper gave back a little bit. Iron ore just continues to have a bit of a rally, and I think if iron ore pops through these recent 6-month highs, the likes of BHP are probably looking like they could pop pretty significantly, given that all of their other fringe things, the fringe commodities are actually making really good margin. I think copper could be more revenue than iron ore in their next earnings if it stays up here at the moment. So that's sort of brewing for a little bit of a pop if iron ore starts to go on a run. It has failed around these levels a number of times, though, so I'm not too hopeful. Bitcoin made a bit of a bounce back, about 2%, but yeah, we did have, there wasn't really much fresh news, because we did look at those earnings results and did the podcast a little bit later on Friday morning. So essentially, there wasn't a huge amount of fresh news. ExxonMobil and Chevron were up a little bit. They were the only ones that reported. We didn't get any more news in terms of Trump over the weekend, as far as I can see, as I checked this morning, but it's just more of the same. So yeah, pretty quick one. It'll probably be a relatively slow start to the week, I would imagine. And then the US has gone off daylight savings, so we won't get the market shut till 8 o'clock. So we'll try and get the morning pot out by 8:30 most mornings, but it'll be between 8:30 and 9 o'clock, depending on how much news there is to digest each morning. So bit of a quick one this morning. I think the SPI was only down 5 points. I don't think there's huge amounts by the looks of things to look out for at this juncture. I don't know if there's any AGMs today. I haven't seen. There's no major updates there. But yeah, we'll have a great day, everyone. And don't forget, we've got, investing in an AI automation and robotics future, the free webinar. That is tomorrow, which is Melbourne Cup Day, I know, but you do get the on-demand and a free ebook if you register now. The link will be in the comments. Have a great day, everyone, and we will speak again tomorrow. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.